Hey, welcome back, everybody, to today's Market Explained, the Four-Star Podcast. We are ready today to discuss what's happening in the financial world as we enter this. Today's the 2nd of July, so we're all getting ready for a 4th of July weekend. But Chris, let's figure out where we stand here for this as we begin the second half in the July of 2024. So I'm Brian Castle. I'm your host, and I have with me my usual co-host, Mr. Chris Reardon. Chris, welcome to the podcast.
Thank you, Brian. Afternoon to everyone out there, and happy 4th of July week. I'm glad to talk a little bit about the markets.
A great week, Chris. Chris is our four-star director of development. I call him the master of all things portfolio. He's still a Cleveland Indian fan. I can't shake him of that. He's got a burgeoning, growing young family. So, Chris, again, welcome to the podcast.
Thank you, Brian.
And I'm Brian Castle, the founder and CEO of Four Star. I'm an Eagle Scout and trustee of the National Foundation of the Boy Scouts, philanthropic advisor and advisor to CEOs, insiders, chief dad to Quinn and Evan, and husband to the amazing Tripty. If you like what we're doing and you like this show, please send a copy of it to one of your friends. Tell them all about it. And give us a 5 out of 5 ranking on Apple iTunes. That always helps our numbers. And we're getting exposure. We're actually ranked in the top 1% of the 3.5 million active podcasts that are out there. So we're proud of that. And we want to keep those numbers going and expand our base. So please, again, give us a 5 out of 5 and send a copy of this to your friend. Just email it to your friends and they can have a look and maybe sign up as well. So, Chris, we're going to do our markets. We're going to do the economy and then generally what things that we see out there that matter to investors. Chris, why don't we start with the markets? Where do we stand with the major 6 asset classes? Any changes since our last episode?
Yeah, so it's actually been relatively quiet since our last episode. We had a big shock last episode with international equities kind of bumping down into that 3rd position from the number 2 position. Since then, everything's kind of settled down a little bit. So domestic equities is still leading the way in the number 1 position. It's at 313 tally points, and it actually picked up 1 point, gained 1 point since the last podcast. Commodities is still in that number 2 position, and it's at 255, and it has actually lost 1 point. International equities, as I said in the beginning, dropped to 3rd, but it's at 254 tally points, so just 1 point behind commodities there, and it was equal since the last podcast. So after that initial kind of drop, we've seen that kind of stabilize and hold there. And really, commodities and international equities, I would say, are really almost pretty much tied in the number 2 position there. 2 and 3 positions are pretty much even. And then cash, we see a big drop off there in the 4th position. So it has 118 tally points, equal. Currencies is in 5th at 80 tally points, equal or unchanged from the last podcast. And fixed income is in last or 6th place at 70 tally points, and that is equal or unchanged from the last podcast as well. So not a whole lot of change. I think it is interesting to note we did see international equities stabilize. And if you guys recall, or if you listened to the last podcast, that dropped mostly off of the news out of the EU and some of the elections there that were much further right. We actually saw a similar thing recently happen with France and the snap elections. Marine Le Pen's right-wing party is expected to pick up a very, very large amount of seats there as well. So that volatility continues, but it seems, as far as the shock to the asset class, it seems to have, for the most part, stabilized so far.
Yeah. It's interesting to look, Chris, and you go through those numbers that there's about 1,100 different readings between all the relationships of all the different indexes that are represented in those 6 asset classes. Cash currencies, fixed income, U.S. equities, international equities, and commodities. But only about 250 of them are embodied in the lower 3, meaning all the positive readings are in the top 3. So we're in a risk-on market. We're in a market where people are taking risk and getting paid for it, right? Whether it be commodities or international stocks or U.S. stocks. And it is interesting to see how commodities is now come back in the lead again in the 2nd position with international fading down there, right? And
yeah,
so
I mean, Definitely interesting. I mean, the commodities play is very, very heavily tied with the economy, not only the U.S. economy, but the global economy. So, if we see a resurgence in the global economy, we had the EU begin to bring rates back down. We see China is really trying to revitalize their economy, so they're trying to pump more money in there, build more. So that's kind of what's going to really drive the commodity markets, which is, there's going to be some volatility there for sure. And then, I would say international equities, it's similar. You have obviously China's attempts to really reinvigorate their markets. And then you have Europe, which is certainly starting to see a bit of a slowdown here, but they have begun that easing process. So did that easing occur soon enough that it's going to kind of spur that economic development that they're hoping to see?
Yes. And we all know that our economy is slowing down. And generally, when that happens, the risk markets don't do as well. But the question is, how fast do we slow down? We're going to talk a little more about the economy in a minute. But right now, U.S. stocks are still the top ranked group, and that's just a contrast to the fact that the international markets are doing worse than ours. Many of them are already in recession. They're lowering rates to get the economy back on track. We're holding rates high because our economy has been strong but slowing down now, and still with high inflation. So inflation is the issue. But yet, nonetheless, our stocks are holding up. So we'll see how long that goes, and what was that signal for the future. It could signal that there's going to be a mild recession, but it could also just be the beginning before the big decline. We don't know. So, but that's where we are today, right, Chris?
Yeah, yeah, that's, definitely markets seem to be holding up, but as we've talked about at length on this, it's kind of fewer and fewer stocks are holding up the market right now. I think I did see this statistic this morning, I think that year to date, so we're halfway through the year of 2024. I think it's close to ballpark 23%. Only 23% of stocks on the S&P 500 are actually beating the S&P 500. So that's
Right.
actually a record low, at least in the last couple decades. So we're just seeing a smaller concentration of stocks that are driving that S&P 500 to new records and higher.
Yeah, so we're having another tech rally. Last year we had a big tech rally when not many other stocks did much. Market was up about 10%, but the index was up 24 because of the concentrated holdings in tech. So this first quarter was basically a reversal of that, where other stocks did well and the techs didn't do as well. Now we're seeing another run. Second quarter, we saw a run again in technology. So the S&P ended the first half, Chris, up about 15%. The equal weighted is only about 5 or 6%, right, roughly in that range.
Mhm.
And the small cap stocks are flat year to date. So we're seeing positive movement, but not crazy positive movement. But again, it's those tech stocks, those magnificent, used to be seven, now it's magnificent three, and they're all doing a little bit better. Again, so here we are in that position again.
Exactly.
So there's not been real much movement in the last few weeks. The uptrend is still in place. Consumer discretionary stocks and communication and IT are up. IT is up 9%. Consumer discretionary and communication stocks up 4%, and just in the last few weeks. So it's quite interesting. But materials and utilities are down 3.25% and 4% respectively. So there's a big divergence in what's working again, like we talked about. And again, and the IT stocks are up the most. And then Nvidia, Chris, Nvidia is a few dollars above where it converted, and 30, as you said, 30% of the S&P return is just Nvidia year to date, which is really crazy. That stock is up 149% year to date. And we also saw the semiconductor sector move into a positive move in our sector levels, didn't we?
Yeah, so we had semiconductors move in to our favored sectors, if you will, that we invest in. I don't think that'd be any big surprise. I think, we've always utilized some of our freelance decision making to kind of pick some stocks that we liked in that semiconductor sector prior to it moving in. What does that really mean? I mean, what we're really looking for with those is we already have some of the NVIDIA exposure, but there's a lot of underlying names that I think that maybe haven't been run up quite as much, that could still have a little bit more room to move. I think the key is, we've talked about this, this AI boom in some ways feels like the dot-com bubble of 2000. I mean, back then you had the four horsemen. So we have the kind of same language being used here. Some of the significant differences, though, here is AI is real. It's definitely going to have a very, very, very much material impact on productivity on the workforce. So there is a more material aspect to it. I think the key is what that impact is, and ultimately who's going to benefit from it, because NVIDIA's obviously is one of the main benefactors of AI. And there are going to be several other companies, but not probably everyone that's getting a heavy move up in equity. So it's a very important time, I think, to make sure you're doing your due diligence as an investor to make sure that you're not over concentrating and that you're investing in the right stocks.
Exactly. So if folks want to try NVIDIA, be careful out there. We own some of that, but we manage it very closely, and we'll take profits when we can, and then limit if it does pull back. But people need to be very, very careful when they're trading in stocks like that are like rocket ships, because it's clearly out, way above its shoelaces right now. But everyone wants to own it, so there we are. Right, keeps running up. And then on contrast, Nike fell 15%. The other day after a fall in earnings, and other brands are taking share from Nike. So there is definitely winners and losers in this market, more winners than losers, but we're starting to see earnings slow down. And that's a particular example of the name everyone knows, Nike. Asics, New Balance, Oka, and ON are the new brands that are out there taking share from Nike. So we'll see if that trend continues. Chris, you found some information about the global equity funds too, I
Yeah.
believe.
Yeah, I thought this was really interesting. So, kind of the 7 days or the week leading up to June 26, global equity funds, so mutual funds, ETFs, saw the biggest inflows, or weekly inflows, I should say, in more than 3 months. So kind of, we're taping this July 2nd, as Brian said, the week of July 4th. So just last week, we saw a big push of people, putting their money into these global equity funds. A lot of that is the expectation the Federal Reserve is going to announce interest rate cuts. So we're going to see kind of the Fed easing. But investors purchased global equities funds worth a net 21.65 billion during that week ending in June 26. So, it's really interesting. I think you have a lot of investors that have money on the sideline. We've talked a little bit about it. The institutional money markets, they're paying 5%. But I think now, especially with NVIDIA, like you said, Brian, the S&P 500 being up 15%, I think some investors are getting a little bit of FOMO. And then now with the markets kind of moving up again off of the expectation of a rate cut, you're getting some of that money that was on the sideline potentially starting to kind of move back into the markets, which interesting, because does that mean another leg up? I mean, you're going to have a kind of an influx of demand, right, in the equities markets. So it's going to be interesting to see how that plays out, with this market. Is it another leg up? Is it kind of a spike up in volatility before a big pullback? We don't really know, but certainly investors are kind of moving their chips in right now, which is interesting.
Absolutely. Well, we'll see. There's a lot of conflicting signals. So we're going up, we're going down, and we really don't know. Time will tell. So, but let's turn to the economy. These are things that drive the markets, Chris. You've got some here for us today.
Yeah, the big news that came out last week is the PCE number, which is the personal consumption expenditures number. This is kind of what the Fed they state quite frankly that this is what they really monitor for inflation. It's their kind of primary. So it rose 2.6% in May, which was flat, and that was in line with expectations. Core PCE rose 0.1% to 2.6%. So relatively tepid numbers there from the PCE, which is, you could use a proxy for inflation. Both reads were in line, and that boosted hopes that the Fed would maybe even cut rates twice or ease twice this year. Maybe now people are factoring in September. The big thing with September, I think people have to realize is even though the Fed doesn't, it says they don't want to be political, that would be right before the election, and that could they do it? Yes. But there are considerations I think they will be made for that. So it'll be interesting to see. But that number being less or being kind of right in line with expectations is positive for that. It does mean inflation has, for the most part, flattened a little bit. I know Powell came out today and said that he would like to see inflation lower. Their stated number is 2%, so that still is above that. But we'll see. I mean, and that obviously any number that is promising or is in line is good to see for inflation. And then we got consumer spending, which increased 0.2% in May, and that was after posting a 0.1% increase in April. So consumer spending is still relatively tepid. So I think what's interesting to note with that, and we've seen this, is the consumer tapped out? We've had this high inflation, and it's important to note, and I've talked about this before, even though inflation's, let's say, clipping at 2.6%, we had about a year and a half, 2 years of, 5, 6, 7, topped out at 8, 9% inflation. We still have individual goods that are well above that 2.6%, especially at the grocery store. I'm sure several of our listeners have felt that. So we still have this high running inflation, and prices are still much more elevated than they were, say, 4 years ago, 4 or 5 years ago. So consumers are definitely feeling that in their pocket. And I think, a lot of consumers were keeping up with that by putting on credit cards, getting debt. It seems like with these consumer spending numbers, we may be at the end of that. What will be really interesting to see is we're entering 4th of July. We're entering kind of that summer travel season. Is that kind of hampered? Are we going to see that kind of pull back a little bit when we usually see people out, going on trips and spending more? So I think the June number will be telling in July as far as where the consumer's at, especially, with debt. Are they racking more into debt? Or are they at that limit?
Exactly. All right. Well, Chris, all year we've been having big changes in expectations on interest rates. And so we came into the year thinking that there'd be 3 to 6 interest rate cuts because interest rates had to spike up last year to fight inflation. Inflation came down from 9% in June of 22 down to about 3%, but it's stubbornly holding in at about 3. It's not going down. So then every other week we have these discussions on whether rates going to go down. And the Fed is saying that about 2 weeks ago that they probably might not lower rates this year. Now there's talk that there's going to be a rate cut now in September again because things slowed down a little bit more, right? So we kind of have this constant discussion. The IMF, International Monetary Fund, is saying the rates should stay steady over this year. So we'll see. It's really anybody's guess whether we're going to have an interest rate cut this year. Wouldn't you say, Chris?
Yeah, I mean, the market's going to do what, it's going to price in whatever kind of wants it. In that regard, it's in some ways like Vegas, right? So it's, they have a bets kind of going, if you will, on when are they going to ease? Is there what chance for them to ease in September or December? When's the rate cut? So, it has its own numbers that are pushing the markets one way or the other. That's why we talk about this a lot. It's obviously does have an impact. But no one really knows. Only really those Federal Reserve officials know, and ultimately what's going to be that decision when they get to that point. It's really anyone's guess.
We'll see. And the Fed, of course, has always had a target of 2% inflation or less. And they said then, and Powell has said over and over, for Chairman Powell, that they're not going to lower interest rates until we get to that level. And then, of course, now there's people pushing the Fed, including some people in the Fed, to say 3 is the new 2. So now that we're at 3, it's okay, and we can lower rates now. But that we're still seeing inflation pressures in the economy. 3% inflation is more than acceptable. So I think they're going to hold out, Chris. But that's the other wild card. Will the Fed hold out for their target of 2, or will they adjust their expectations up a little bit, which I think would be a mistake. But that's the betting. We're not sure what's going to happen, but that's the talk. We'll find out in the next few months. Um, Other things affecting the economy, the median home price went up to a record level of 419,300 um, for a home. So obviously, a lot of young folks getting out of college, new jobs, they don't have $419,000 or a 20% down payment for a home like that. So they've got to either get that money from other people, maybe other family members, or it'll take them 10 years to save that, right? So affordability is really an issue. So the housing stocks have been going down. That said, there's still a 6 million home unit shortage in America. So while we may have a short-term situation because rates are high and the median home price has gone up, eventually the housing industry is going to have to build more housing. But a lot of the stocks got hit, like Lennar and Toll Brothers. These are the luxury homes. They're doing a little bit better because the wealthy still have enough money to buy homes, but the other home builders have gone down quite a bit. But we think they'll eventually have another run. It's just a matter of time until all the sellers get out and the buyers step back in. But if you've been investing in housing stocks, be careful. But they've been taking a beating here lately. And in those markets, Chris, it's like now it's like what was hot is now not. Austin, Texas is a very hot market. Tampa, Florida, and the Florida area is a very hot market. Those areas now are slowing down a little bit because they got too overheated, and they're being replaced in growth by areas that were previously not growing at all for a long time. New York City, San Francisco. Other hot markets include Philadelphia, Nashua, New Hampshire, and areas in the state of Connecticut that people haven't seen show any strength in the real estate markets in quite a while. So things, always change. There's always rallies and general trends, and then mini pullbacks in those rallies. And we're seeing one of those right now in the housing markets and the strong demographic areas like Texas, Florida, Arizona. That's where people are moving. But now those got overheated and those prices are coming down a little bit. And then some of the other areas that were down are growing a little bit. One thing we are seeing though is because there's a lot of folks who can't buy, their renters are increasing. So, and renters hoping to trading up to buy the REITs, the real estate REITs, Avalon, Camden, Mid America REIT. Those are all publicly traded REITs. Those are trading well, and so that's an opportunity, for investors. Chris, you did a little bit more work in international. Tell us a little bit about that.
Yeah, some interesting news kind of on the international front. Russia came out and said that they're going to start gas exports to China in 2027 via their new Siberia pipeline. They plan on kind of pumping 10 billion cubic meters per day, and that's starting in 2027. So we continue to see that integration. One thing that with this Russia-Ukraine war, we've seen this kind of moving away from the US and the European Russia and kind of Russia and China becoming closer. So they continue to move and integrate their economies and their commodities. So that's very interesting to see. Staying in the Asia Pacific, we've talked a little bit about this, but the Japanese yen continues to have issues and it continues to weaken despite multiple interventions by the Bank of Japan. So it hit its weakest level since 1986 versus the dollar. And it hit a new low versus the euro at 171 yen per euro. And it was 161 yen per dollar. So they continue to have issues, maintaining that weakening yen versus other currencies. And what impact kind of does that have? Well, in Japan, one of their major banks, Japan's Nironshin Bank, it's planning on selling around 60 billion worth of sovereign bonds. So that's other governments' debt, including treasuries, and that's to cover huge losses in their fixed income portfolio. So just like Silicon Valley Bank, these banks put out bonds. In some cases, they put out bonds or for higher duration or for 10 years, 20 years, longer periods. Those are fine. The issue is interest rates go up. So one of the mechanisms Japan has to defend its currency, its severely weakened yen, is to raise interest rates. But if those get raised, these banks bonds essentially become much depreciated in asset value. Now, the issue with that, unlike Silicon Valley Bank, which we kind of got bailed out and all that, the Reardon Bank, the Japanese bank, holds roughly 20% of all Japanese foreign held bonds. So what we could see is a major dumping of billions of dollars worth of U.S. Treasuries, which could cause the U.S. Treasuries yields to spike. If you supply and demand, if you oversupply the market, you're going to see yields move higher because it's just going to get cheaper. So it's going to be really interesting. If you see those yields happen, that's going to continue to put pressure on the yen, and it's really a spiraling effect that could happen there. So, kind of long story short, I would say is there's still a lot of potential trouble coming in Japan, and this could have a major impact not only on Japan but on the global markets. One interesting thing I'll add to that is there's a record number of asset managers and hedge funds that are currently short their exposure to Japanese yen. Essentially, they borrow in yen because it's so cheap, and then they'll allocate that somewhere else. So if the Bank of Japan does raise interest rates to defend their currency, we could see a rapid appreciation in the Japanese yen, and we could see essentially a currency crisis potentially. So just something to keep in mind. I know that's very technical in several senses, but something we're keeping an eye on here and something to note. And then the last thing from an international front, I would say more on a bright note, is India had a really strong move in June. Their equity indexes came off of record highs on Friday and ended June with their best gains of 2024. The Nifty 50 was up 6.6% in June, and the Sensex was up 6.9% in June. So a lot of this came off of Minister Modi coming back to power. Some of the initial news, which we talked about on here, was they thought he would gain more of a consolidation in power, which he did not see. But I think after the markets digested it a little bit, they saw that kind of the moderation there may in the long term end up benefiting. So that was good to see. We saw a kind of more of a resilience out of India.
Nice. Well, good. And then we did see a third straight week of movement upward in oil too, Chris, and
Yep.
back in the domestic trend, and so you could borrow in yen and then buy oil with cheap leverage, right? So there's all
Exactly.
there.
Exactly. Yeah.
So one of the things we talked about on our podcast before is how policy prescriptions lead to different outcomes. People respond to incentives. That was the first statement they made when we went to the University of Chicago Business School. People respond to incentives, and business is a study of incentives and understanding what happens. So, very interesting policy, leading to outcome situation is developed with regard to wage growth. So the numbers are coming out now in the Biden administration every year on wage growth, and in the 8 years of the Obama administration, we had negative wage growth, and a lot of it had to do with policies. The first couple of years was a recession, a holdover from 2008 recession when Obama got inaugurated in the fall or in January of 29. But we went through 8 years of Obama administration policies, and we had negative wage growth actually each and every year during his presidency. Then, ironically, in the Trump administration, they changed policy, lowered taxes, did different things, and they had 4 years in a row of positive wage growth. We've now seen 3.5 years of the Biden administration, where we've seen negative wage growth the entire time. So, that is I heard that, I checked out those statistics. That is a pretty clear statement about how policy leads to outcomes. We're not talking about politics here. We're talking only about policy. Now, there's always an issue of causation or correlation, and some of those years were not necessarily caused by the president, but some of them obviously were 8 years, in the policies of the administration. So it's not politics. We're talking about just pure policy. We are in a political season now, however, because of the election coming up in November. And I call it silly season because people say a lot of things just to get elected, thinking the public won't understand it. And sometimes it's true. I heard one of the politicians say that they created 15 million jobs, and actually it was only 9 million jobs from a COVID recovery, but then only about 6 million jobs of actual growth. So one president saw 15 million jobs lost on his watch from the pandemic, and the other one saw 15 million jobs created on his watch from the pandemic. So I don't think either president can take credit for those things. So we're in silly season. We're going to hear a lot of numbers. We're going to hear a lot of claiming about this guy's a liar and that guy's a liar. And the reality is both sides are making what we call hair on fire whopper lies right now. So be careful when you hear numbers and facts, and check them out, because a lot of the stuff you're hearing that it relates to the economy and how well they did is not true on either side. But Chris, let's move to what we see out there. You've got some details on the verdict.
Yeah, so interesting. The NFL was kind of embroiled in a antitrust trial regarding their Sunday ticket package, which allows consumers to purchase out of market television rights so they can watch their favorite team if they live in a different market. So the trial came to a conclusion, and the NFL lost. They were hit with a $4.7 billion verdict in the antitrust trial. So essentially, this boiled down to is the NFL would sell the Sunday ticket package. AT&T or DirecTV had it for a while. Google or YouTube just purchased it last year. It was the first year for them. And you have to pay $300-$400 to get access to NFL games that aren't on in your local market. What the trial was really over was that's unfair, that people should be able to just purchase maybe to watch their one team instead of having to pay $400 for everyone to watch other games. Maybe I only wanted to watch the Cleveland Browns, for example, and I'm in Chicago. So what if I only wanted to pay $40 or $50? Is it fair to have to pay this outrageous price to watch a lot of games that I do not care about as a consumer? So it'll be interesting to see how it pans out. I know the NFL is going to come back and contest it. So we'll see maybe if there's any validity to that.
Interesting story. And NFL has obviously been very, very profitable, but they don't win every detail. So apparently this time they're a loser on it. We'll see.
Mm-hmm.
And there's a new team in Detroit. They also, in Detroit, saw Ford Motor refurbish the Michigan Central Station, which has been used in the press now for about 40, 50 years as a symbol of the blight of Detroit. And so as the people moved out and all the services shut down, they even shut down neighborhoods, or they told certain neighborhoods, this 8-block area, we're turning off water, electric, and sewer and everything to save money on services and not maintenance. So now the Michigan Central has been refurbished, and they're using it as an events space for Ford. And so a lot of the cities are being revitalized. So some things, that go in the wrong direction, eventually they bottom and they start coming back up. So we're happy to see that. One of our sons went to University of Michigan, so we'd visit Detroit pretty often. It was pretty bad for a while, but it's getting better. And you're seeing some excitement. It bottomed really about 2001 as far as the real estate market goes, but the population still hasn't been going up. So now we're starting to finally see that 20 years later. We also talked a little bit about, just on another note, correlation and causation. So certain facts and things happen at certain times, and then was it caused by something in the economy, or is it just correlated, meaning it happened at the same time, but they're unrelated? So there was a famous McKinsey study, Chris, I wanted to talk about, suggesting that diversity is the road to better profits, but that is now being questioned. So they did surveys recently with 186 companies, and they found that higher profits happened for those companies that were diverse at the end of the survey. But that is correlation. That doesn't prove that it was caused by diversity. And it's turning out that that's not the case necessarily, because they've now found other sorts that didn't work out that way. But that diversity argument, which is a political argument and could be very positive, that's good for society, but that was used as a reason to diversify boards and introduce diversity, equity, inclusion. BlackRock, NASDAQ, and the exchanges did that. Well, now a lot of that is going back the other way. They've never been able to prove that diversity necessarily is the reason for economic growth. It's a good outcome in many ways for America, but it isn't necessarily the reason. Now, in the article that I read recently, they talked a little bit about, how do Black and Hispanic graduates of the top business schools? Like I went to University of Chicago Business School, there's Harvard Business School, and the reality is, I can tell you firsthand that all we had Black, Hispanic, we had female members of our class, so it wasn't all white males. And everyone basically thinks the same. Everybody has the same view of business, how to get business done. We all learned from the same school. So I can speak as a graduate of the Chicago Booth School that number one, folks do think the same way in business. So it turns out business is colorblind. And we tried to build a colorblind society where everyone is judging the content of their character and each to his own merits. And that's exactly what we've created. So all these other arguments about diversity necessarily being the reason for economic growth aren't necessarily true. It's a good outcome, and I think it's a good thing we should shoot for, but that's not the reason for economic growth. Economic growth is people making their decisions for the right reasons and allocating assets and allocating resources in a proper and efficient manner. That's what makes business grow. So why don't we all go forward and make good decisions, no matter your race, sex, color, creed? That's the American way, everybody. I just wanted to bring that up as we saw that change, Chris, in the McKinsey survey. So,
Mhm.
and then one last thing, we're getting to the end of our show, Chris. Anything else on your plate?
No, I mean, just a couple things that I think are kind of interesting. I think, as you said, Detroit's coming back. I think we're seeing a lot of what was termed the Rust Belt cities coming back, and I think one thing that's playing into it is these record high home prices.
Mhm.
You have these Rust Belt cities that home prices are more affordable. You're seeing more and more, move to Detroit, move to Cleveland, move to Pittsburgh. You can actually get a house there for $200,000, $300,000 instead of paying $420,000. So I think that's, one of the big things playing in. There's a big housing markets there that are affordable. People want to move into homes and start families. So, that might, I think, help spur that growth there. So it'll be interesting to see if that, what the impact of that is.
Yes. Well, the things do cycle. They go up and they go down, and there's opportunities when there's things are bad. So it could be a great opportunity. I know there clearly were reasons why Detroit developed where it did. There clearly were reasons why Cleveland did. They're on a beautiful lake. It's a great area. So things are coming back, and that's really great
Mhm.
stuff. Um, I just wanted to highlight to everybody, we have the blog post on the fourstarwealth.com website. And many of our advisors do issue very interesting articles. So you can go onto those blog posts and sign on for any of them. And then you get regular feeds on what we put out. We recently put out an article about zombie companies. And the reason why that's important is we saw some of the banks fail recently. The big one was Silicon Valley Bank and a few others. And now we're looking at, most of the banks have become more healthy. The Federal Reserve has worked hard to keep the banks in better shape, but there still could be a number of regional banks that fail over the next few years if interest rates stay high. But we're now seeing a lot of what we call zombie companies, companies that issued enormous amounts of corporate debt when rates were 1% and 2%. A lot of that debt is rolling over, or some of it is adjustable debt. Rates are higher. So now we have an article on zombie companies. So zombie companies are companies that are just hanging on long enough to pay their debt service, but at some point the debt service kind of reaches up and chokes the company, and then the company would fail or have to sell, and the stock would go down, or a private stock valuation would be much lower. So have a look at that. That's a big risk here in this kind of an economy, that we have a lot of companies that will fail because they have not dealt with their debt. So have a look at that one. And of course, also on the Four Star website, you can have a link to all the podcast interviews that we've done, and the audio and the video of the podcast. Also, you can access this podcast from Apple iTunes, Spotify, Google Podcasts, and all the services. So, feel free to share all those again, as I mentioned, with all of your friends. So, Chris, I think that's all we have today, right?
Yeah. Thank you, Brian. Thanks to all the listeners, and we'll see you next time.
We hope you have a great 4th of July, everybody, and we'll leave it there for today. The 4-star Today's Market Explained podcast for July 2nd, 2024 is over and out. Thanks, everybody. We'll be back soon. Bye-bye now.